101A is the third of three critical tax codes I think would be in your best interest to understand. First two is 7702 and 72E. We had videos on those. This we're just going to look at 101A. Now you'll see it's much simpler than 7702 and 72E, but you do need to be very careful understanding this. The reason why is we'll see people trying to take advantage of this in ways they believe is in their best interest, but generally is not, and there's a reason the insurance companies allow them to try and take advantage of it. Third, we'll look at how this actually plays out in practice. Hi, my name is Daniel McCluskey. It's one of my goals and desires to make these videos as informative and helpful as possible to you. Let me know what I could have done better, what was wrong, maybe in the comments afterwards. Really appreciate it, it would help. Thanks. Now first, tax code 101A does not just tell you life insurance proceeds are tax-free. What it also allows you to say is if you max fund, for example, an index universal life contract or a whole life policy, and that grows tax-free, you're accessing it tax-free or not, it will still transfer tax-free as opposed to like a traditional IRA or 401k where they might have to pay taxes on that. That's the first thing. Now, for reference, 101A is not just as simple as that. So again, similar to 72E, we have to look at a lot of places. First, we have to look under subtitle A, which is under Title 26, aka the entire revenue code. Subtitle A is titled Income Taxes. Under that is Chapter 1, which is titled Normal Taxes and Surtaxes. Under that is Section 1B, Computation of Taxable Income. Under that is Code 101, which is titled Certain Death Benefits. And finally, under that is 101A, it's a lowercase a, and that is titled Proceeds of Life Insurance Contracts Payable by Reason of Death. Now there's three sections under that, two sections under those three, so it's not quite as long as 72E or 7702, but still important. Simply put though, what's most important is we'll look at 101A and then under A, number 1. This is the first subsection. This is what really you need to understand, and that is just this. The general rule says, except as otherwise provided in paragraphs X, Y, and Z, gross income does not include amounts received, whether in a single sum or otherwise, under a life insurance contract if such amounts are paid by reason of the death of the insured. So you have insurance, the person dies, you receive it, not taxable. Now the second thing is understanding how you can take advantage of 101A and really being careful how you do this, because some people will do things that they think is in their best interest, which might not be depending on their actual goals. Now, to kind of provide some context for all this, life insurance in general is an industry and companies provide it, and they are businesses. So obviously they are trying to make a profit. So when they offer you something such as life insurance, let's just use whole life insurance as an example. They say, okay, we'll give you $10,000 in coverage, guaranteed, whenever you die, we will pay that out to you. But you have to pay us $100 a month to get that. What the insurance company is saying is based on your health or medical records or all the things that they have, is that they believe that one, you'll pay $100 a month enough times to where that exceeds $10,000 by the time they have to pay you when you die, or two, you'll pay $100 enough and then they'll get interest on that to where that will exceed the $10,000, therefore making it a profitable quote unquote wager for them to bet that you will live longer than you think you do. You might say, oh, well, then why would I make that deal? The reason is, if you're basically saying, hey, I realize this is a non-profitable wager just in terms of money, but in the event that I did die very early, it'd be really tough on my family to have to come up with that money to maybe pay for my funeral. So I am willing to take that risk or non-profitable bet, because what I'm doing is I'm also factoring in things outside of money, or I'm equating other things to money to where then it actually becomes profitable. It's like a thing that poker players will use called ICM in a poker tournament, for example. So let's say you are one person away from making the money. If you make it into the money, you will get $100,000. You just need one more person to get knocked out, and there's 100 people playing. All you need to do is last one more player and you'll get the $100. But if you're the person that gets knocked out, well, you'll get nothing. What you might do is you might fold hands that even though you have a 90% chance of winning, say, it wouldn't be worth the risk, because if you lose, well, you don't get any of the money. You get $0. But even by folding and knowing that you're making a non-EV play, you still might be making a positive EV play in the sense that $100,000 is very valuable to you, and you would rather take that money and lock that in as opposed to just going for the grand prize up top, which might be a couple million. A second way at looking at this is, let's say someone came up to you and said, hey, let's flip a coin. If it's heads, I'll give you $20. If it's tails, you give me 10. You'd be like, yeah, I would definitely take that. Now, you might not take it if they say, hey, if it's heads, you pay me $1 million and I'll pay you $2 million. You still might not take that because let's say your net worth is $1 million. Well, you're not going to put your whole net worth on the line for a coin flip, even if it would be positive EV to do so, because if you lose, that's very detrimental to your retirement, your future, even though technically in the long term, you're going to win a lot of money in that bet. You still wouldn't do it. Now, my point in explaining all this is what some people will do for wealth transfer is instead of just max funding an IUL and letting that grow tax-free, sometimes what they'll do is instead of having the minimum death benefit and the most amount of cash value, they'll actually increase that death benefit and have a very small amount of cash value to where they're saying, well, if I put my $2 million in and I die early, it's going to blossom and transfer to 10 million. And I don't really need the money, so I just want to maximize the transfer to my heirs. Well, that logic seems sound on the surface, but what we don't realize is if the insurance company is allowing us to buy 10 million insurance for 2 million, they're a business. They do realize what they're doing. What they're saying is, hey, we'll do that, but we actually think that by the time you do pass away, we could have put that 2 million somewhere to where it's grown greater than 10 million. And they're doing that based off their health tables, your medical records, that kind of stuff. So you can do that and it's fine to lock in, say transferring the 10 million, but keep in mind the insurance company realizes you're doing this and they actually tend to think if you would have just put it in and max funded it and did the least amount of insurance, probably would have grown to even higher than the 10 million. That's why they take the bet, quote unquote, in the first place. So be careful when you're doing the wealth transfer. It's not that it's not okay to do, it's fine to lock that in, but again, you just need to know what you're getting into and that you're making a non-profitable wager in the insurance company's eyes. Third, how does this actually play out in practice? We're gonna go over two scenarios. So the one is you did the max funding to where you had the least amount of insurance, the most amount of cash growth, and you let that grow over the years. So say you put in $1 million, it grew to 3, 4 million, it doesn't really matter over a certain period of time, and you pass away. That money grew tax-free, you might have accessed some money tax-free through a policy loan or withdrawal or relieving your principal, and then you passed away. That money, whatever's left in the death benefit, will transfer tax-free. It's not gonna be taxed like 401ks or IRAs, for example. The second is going to be if you structured it for wealth transfer. So again, back to that, you put in $2 million and got a $10 million death benefit because you wanted to maximize how much you left behind to your heirs. Again, maybe not the wisest decision. Maybe it is based on your risk tolerance and your goals. But if you do that, let's say you put in the 2 million, whenever you die, assuming the policy is still in force, that will transfer to your heirs, again, tax-free. Now, we'll go over this in more detail with some software and stuff in some other videos, but for this one, just kind of a high-level overview of 101A. So hopefully that was helpful. Again, if you had any questions or anything, leave them in the comments and we'll get them answered. Stay tuned. The next series, we're going to go over TEFRA of 1982, DEFRA of 1984, and TAMRA of 1988, and how those also play into your life insurance contract. We'll see you there and make sure to subscribe.